I'm really excited today to have Nick Boden speaking today for our featured meetup. Nick, I talked a little bit about my start and my beginning in multifamily. I was just getting deals done however I could. I just had it, whether that's 10% of the pie or 100% of the pie, I didn't care. I just wanted to do multifamily, and I was building a business. And that kind of, Elevate was doing the same thing in the beginning. They had maybe had small percent of the partnership, but as you grow your business, you become more vertically integrated and bringing more pieces of the pie, getting really strong team members so you can take down more opportunities, be stronger for opportunities when they are good or bad. And Nick was is our best hire that we've had. And, I'm super excited to have him on the team. He's dove in on our existing deals, goes it back to how we underwrote before we bought the deal, how they're performing now, trending that, and then also on the acquisition side, underwriting new deals, helping us protecting our downside, and how we're structuring those deals, getting really creative with developing deals, structuring, has a lot of experience. Fresh out, he's a young guy, he's 29, you've met me, I'll be 33 tomorrow. Nick has a ton of experience already, fresh out of college, was at JP Morgan's real estate division, and from there, worked for a multifamily firm in Miami, helping on the acquisition side, and then 3 years for one of the largest nation developers in Dallas, helping them on underwriting deals there. So a ton of experience in a short life, and I'm a speaker today. So
that's great.
Welcome.
Great. Flattered for the intro there, Brian. Appreciate it. Great to be here, everyone. Some familiar faces, good to connect face to face as well. Excited to talk about how to underwrite multifamily acquisitions. Going to talk about the mindset, going to talk about the numbers, going to talk about risk mitigation, talk about a case study. So a little bit of everything. Feel free to interrupt me and answer any questions throughout. And we can just go to the first slide here.
We're also live streaming to the Northwest Arkansas commercial Facebook group, so making sure we have that. Some people may be asking questions during your presentation. We'll be monitoring that, and this is definitely ask Nick as he starts to, you can stop Nick at any time, and this is definitely open forum. That's speaking for you, but
no worries. All right, we already talked about intro. I don't need to beat a dead horse there. Chapter 1, what makes a successful acquisition. I think a lot of people have their opinions on what makes a good deal, what makes a bad deal. I try to boil it down to 3 simple bullet points here, 3 steps to a successful acquisition. I think finding motivated sellers, finding some sense of motivation. Why are they selling? There's got to be a reason why they're selling. Step 2, kind of develop a realistic business plan and early communication with the property manager. This is probably the most difficult part of the process, I'd say. Although, sourcing a deal is obviously difficult. There's immense value in that, but actually developing a business plan, a realistic business plan, is incredibly difficult, but incredibly important as well. Step 3 is structuring the deal to avoid being a motivated seller and forced seller. So the cycle kind of continues there. You don't want to be step A, you want to be avoiding to be a forced seller. Right.
The motivated seller isn't just someone who wants to get the best price on the deal. They have some sort of capital event they need to capture. They want to get out of the deal. They want to place their money somewhere else. It's not just someone who's been sitting on it.
Yeah. So we'll talk about that a little bit right here. So how do you kind of find motivation? Why does the owner want to sell? Sometimes it's a developer looking to exit, whether they are, ready, or just a merchant builder and they do a 3-year business plan and move on to their next development. Maybe it's a fund that's ending their life cycle. Maybe it's an upcoming loan maturity. Maybe the owner is retiring. That's sometimes a common theme that you're seeing right now with the age gap and baby boomers retiring and they're passing on their wealth to the next generation. Sometimes there's a disagreement within a partnership. Those can get kind of hairy, but can lead to good opportunities as well. And so where do you kind of find these deals? There's pros and cons to how you find these deals. I think there's a lot of good on-market volume deals. The con to that is there's typically a large buyer pool because it's easier to find those deals. Communicating with brokers, having great broker connections is very important. Off-market, smaller buyer pool, more direct sourcing approach. And sometimes, a broker will plug you in with a opportunity where there's maybe 3 or 4 buyers. So you're more in control in that deal. In a sense, there's not going to be a big bidding war with 30 different parties. And then the third way, in my opinion, direct to owner, doing that a lot right now, whether it's cold calling, mailing. I haven't done any actually physical mail yet. Going to probably start doing that pretty soon. Heard great things about it. But yeah, direct to owner is a good strategy as well. And so kind of just plugging those 3 strategies into the acquisition funnel is how we're looking at stuff right now.
I have a point too. Yeah, you kind of talked on that. Like, this is the same reason investor or owners want to sell, but also at the same token, you don't, like Nick said, you don't want to be this on that back end. So this is really important, making sure you're underwriting your exits, making sure that you have your exits for your funds, you're underwriting the debt conservatively. What's your exit debt? Are you looking to refi? Is refi part of your underwriting, or are you just looking to sell? Disagreement with partnership, we've seen this on a lot of our deals, and I talked about that in the beginning. You're just trying to do deals however you can, so maybe you have a small percentage of a partnership. So if you're doing deals with partners, and that's kind of the goal of this group, is do deals with partners, make sure you have that in writing upfront. What are the roles and responsibilities for each partners? What are the expectations? So, and structuring that appropriately too.
All right, so, step two to a successful acquisition, developing a realistic business plan. I've only been in the space for roughly 3 years now, so don't have as much experience as a lot of people here, but I can say the one thing I've noticed in the past 3 years is there's been a lot of miscommunication between an acquisitions team and an operations team. And that marriage has been very hard to find and communicate early on. So I would say to make a successful acquisition, having early on communication with the property manager, creating a very realistic operating budget and setting expectations early on is one of the most important things that you can do when creating a successful acquisition. So, some things that I've mentioned here is also loop in construction teams early, get their take on CapEx budgets. I'm not a professional on how much X, Y, and Z is going to cost, how much a doorknob's going to cost, how much, all this stuff's going to cost. I'm going to loop in the GC or sub early, get their take on pricing so we can, develop the scope and CapEx budget down to the last line item there. And also, compare how the property has performed historically and how are we going to actually improve the operations. That's the really true value creation that we'll dig into a little bit later here.
It's really important to get vendor, like actual hard number. You're not doing that for every, it depends on how many deals you're underwriting, and maybe you're doing that in the beginning, but it's really important to get live numbers. Yes, you want to use rules of thumb just to see if the deal passes the sniff test or the initial pass, but you're pretty close, and it makes sense to reach out to an insurance agent or reach out to a title company or reach out to some of these property management companies or construction teams to get those hard numbers, so then you can really sharpen the pencil.
All right, and point 3 is avoid being a forced seller. I already spoke about this a little bit, but yeah, debt maturing, can't afford a cash in refi. That's pretty common right now with the higher interest rates. Developer budget busts, and sometimes a lender that's lended on a construction deal is, they're done. They want out. The budget's been busted, and they're going to force a sale. Definitely don't want to be on that end. Can't afford. Maybe the owner can't afford any monthly shortfalls, operational shortfalls, because there wasn't adequate reserves underwritten, something like that. So you don't want to end up in any of these instances. And really the main takeaway is just underwriting structured deals to avoid being a forced seller. So we'll talk about that more in detail. All right, so chapter 2, high level underwriting. So I mean, the name of the game, in my opinion, is volume. It's deal sourcing and it's volume. If a deal doesn't work at a high level, it likely won't work when you dig in more. So yeah, pipeline volume and deal sourcing is really my priority right now to find the best opportunities. So, I mean, just to give you an example, I've been with Elevate roughly 7 months now. I've looked at probably 350 deals, like underwritten, but that doesn't include like a high level, back of the napkin. We probably looked at around 500, 600. So averaging, I don't know, around 100 deals a month or something. So you're really getting a take on where the market's at and getting an understanding of what is market expectations on pricing and what are sellers really wanting right now? What is the buyer pool chasing? So volume is a yes question.
Well, to that point, I mean, we're in an unusual interest rate environment.
Yes.
You find that, up to 400 or 500 that you sort of passed into your funnel here, and they don't pass that first cut. Do you keep those, or do you reevaluate those under different scenarios, different conditions, maybe 3 to 5 years in the future? Or when you say one is sort of this one doesn't work, you just mark it on?
Yeah, it's a great question. I mean, to me, underwriting, when you receive a deal, you kind of you can kind of forecast 3 months out, but really, I mean, you're going to close, you're going to have a 30-day DD period, 30-day close, sometimes a 30-day extension. So really, the most I want to forecast out is around 90 days or so. I'm going to look at, future leases signed, future resident move-ins. If you're actually under contract on a deal, I'm going to look at how's the T12 trending each month and stuff like that. But if I'm passing on a deal and it doesn't trade, I'm going to call the broker again and say, hey, what happened? Can we get updated financials? Can we revisit the deal? What's, the new pricing expectation? Definitely keeping those deals and I call it like hanging around the hoop. kind of just waiting for, you know, something to change, something to shake loose, whether it's pricing or operations performance or something like that. I think that's a very important thing to do right now because a lot of stuff's not trading. All right, high level underwriting mindset. So, I mean, the mindset really that I try to take is the goal is to be in the ballpark when doing high level underwriting, giving feedback quickly, whether it's to the broker or to the owner directly on where you're coming in on price at a high level, and getting to a yes or no if we're interested or not based on, you know, location. Maybe you get a rent survey in T12 or rent roll in T12 to help you a little bit more as well. But my goal is to take it, put it in the pipeline, and if it's interesting, we're going to move to the next level, dig in more, and if not, we're going to throw it away and maybe revisit it later. So, you know, I'm going to use the broker's guidance for stabilized NOI on a lot of cases, but I'm not going to rely on it. You know, my goal is to come up with my own assumptions based on historical operations, comparable properties, and general market knowledge. The broker is very helpful though for kind of guiding you what makes sense with this asset, where they think they can push NOI in the future as well. A lot of the times though, in these off-market direct to seller, you got to kind of come up with your own business plan because there's no broker involved, which makes it a little bit more difficult.
Yeah, shout out to the brokers in here. I mean, that's like I would say like Nick is worth his weight in gold. I recommend. I mean, a good broker is worth their weight in gold. I mean, same thing like good CPA is worth their weight in what a good attorney is, and I think you can really utilize a good broker.
Yeah,
it's not
definitely.
every just because a broker doesn't mean they're good ones either, but a good broker can help on the transactional side. I mean, sometimes they've been calling the seller for 7 years, and maybe we called them for a couple months, so they might have a relationship where they're the first ones that kind of ideally you can get somebody's direct to owner, but you know, it's timing is a big portion.
Yep, definitely want to rely on broker relationships. So that's their job. They're there to source deals and build relationships. All right, so let's see. More mindset discussion here. Would you buy the deal all cash, or does it only work with debt? You know, do you just love the location? Is it irreplaceable product? Is it just perfect construction, great demographics, or are you really just financially engineering the deal to make sense on a return basis? I think it's a pretty important mindset to have because you're buying real estate at the end of the day. In my opinion, everything's kind of a covered land play. And, you know, in the future, 50 years from now, is it good real estate or not? Class C deals, another mindset tip I like to think of is, you know, Class C deals, depending on location, vintage, like why is it actually Class C? But a Class C deal can technically be a low risk deal if the basis is low enough. You know, everything is a price. Risk is associated with return and basis coming in. So, you know, a Class C deal can be considered, in my opinion, low risk if it's structured properly. And on the other end, a Class A deal, meaning new construction, best amenities package, can be high risk if the basis is too high, assumptions are too aggressive to make the deal debt service or pencil or whatever you want to call it. So, you know, sometimes people think the inverse of that. It can be either way. No, a Class A deal can also be low risk. So just wanted to caveat that there.
How do you classify Class C or Class A?
Yeah.
Property?
I think a lot of people have a different opinion on it. I mean, to me, a Class A deal, I'm going to look at the location. What are the demographics? Who lives there? Is there good retail around it? Is there good entry and exit points on it? And then I'm going to look at the actual property type, construction type. When was it built? What are the rents in the area? What's the amenity package? General finishes of the units. So those are just some of the questions I'm going to ask. But I mean, you know, there's different definitions, but I would say a Class A deal is going to have top of the market rents, probably the 90 plus percentile rents. You're probably going to have 90 to 95% economic collections. You're not going to worry too much about bad debt or any collection issues or vacancy, hopefully, depending on supply, but it's going to be more, it's going to be a less operational headache type deal with more consistent tenant base, in my opinion.
Like school districts would also be.
Yeah, another great point. Yeah, school
So
district.
it's all correlate. I mean, that's like a high level, like the third grader and me, I'm like 1980s and older is C class, 2010 and newer is A class, and everything in between probably B class. I think I look at it like vintage, but that's like high, like, but if you're looking at that kind of, you're probably not building a 2020 C class, like a new build isn't going to be a C in a C class area. You're probably not going to be, depending on what the business plan is there, but I think some people look at it just vintage, and then some people look at it what Nick was talking about there. It's a big factor in A class, B class, C class, and it's usually correlated with what Nick was talking about as far as how the property is running and location and school districts.
Yep.
All good points.
So is that a typical, like, it may have been an A class in the eighties and then it moved down to a C class just over time?
Yeah, right.
Oh, okay.
Economic.
That's your bread and butter right there.
Yeah, if the location's A class, but the product type is kind of deteriorated to a C class, I mean, that's prime value add potential right there. Bring it back to, put more capital into it, bring it back to what it used to be. Location will solve itself.
There's a lot of buyers that are only looking for one class. That happens a lot. Somebody's only looking for A, somebody's only looking for C. So some people do it all, but there are specific people that are only shopping for one type.
When you say classes dependent on market, like A class building here isn't gonna be an A class building in New York City.
Yeah, it's a good question.
It's generally, I mean, generally, but the terms are a little different, but
Yeah,
I mean, no, we're listening by the customer.
Yeah.
In terms of characteristics.
yeah, I think an A class in New York City is gonna have like,
Yeah.
$8
Yeah, that's
per
a
square
different
foot
animal.
or something.
Yeah.
So, and the finishes are gonna be different than an A class here.
A class in New York is gonna have a smaller square footage,
Yeah.
it'll still be A, whereas here it would be a retail park.
Right, yeah.
Every market's different.
Yeah, I think it's very difficult to put things in buckets and call it A class. That's why I like looking at the whole scope of information on a deal and weighing it all that way. But it is sometimes helpful to say, all right, this is A, B, C class.
especially if you just think, if you just do age, yours was very expensive, but if you just said age, it puts you in one of the streams at least.
Right,
Yeah.
right, yep.
Yeah.
Okay, cool. All right, so I mean, here's just a brief example here for, say I get a deal, I'm talking to a broker or it gets blasted in my inbox or just talking to a seller directly. So I mean, for this example, it's a 2007 build, 200 units, 875 average square foot, calling the Kansas City metro. Pricing guidance around 38 million bucks, price per unit $190,000. I mean, the first thing I'm gonna do whenever I get a deal is I want to know the story. How long have they owned it? Why are they trying to sell it? What's pricing expectations? And if there's any distress or really where's the value add? Sometimes you have to find that on your own. But for this example, the owner is ready to sell after owning for 10 years. He's retiring and he's very motivated to sell, but he's not a forced seller, meaning he doesn't have a loan coming due or there's no shortfalls or anything like that. So he's an out-of-state owner. He doesn't operate any assets nearby. Based on the comps, you can push rents roughly $50 to $100 with minor unit upgrades, stabilize around $1,700 to $1,750, $1.97 a square foot, can likely reduce some OpEx. So this seems decently interesting. There's some good story here. This guy's retiring. The rents on a chunk rent basis comparing to the per unit pricing guidance, that's pretty interesting as well. $1,750 versus $190 price per unit. It's decently close to a 1% rule there, but I mean, I would take this deal and I mean, the first thing I would do, get the slide to go to the next slide. There we go. I would just plug it into a simple template like this. So the thing that we're looking at on the left here, this is
Just a second.
relatively simple. Just bear with me here, but I mean, this would just be a one tab spreadsheet, pro forma, whatever you want to call it. You're going to take your historical operations from your gross potential rental revenue, take out concessions, bad debt, vacancy, economic loss. You're going to add in other income, and then you're going to take down operating expenses to get you in place NOI on a trailing 12-month basis. That's what the property is generating today over the last 12 months. Sometimes there's a difference between, trailing 1 month versus trailing 12, but I'm not going to get into that now. Then if you can get, how much CapEx they've spent to date, that's helpful, but not really required here. Then if there's a broker involved, I'm going to get their opinion on where a stabilized NOI could be pushed, whether it's a year 2, year 3 stabilized NOI. Doesn't really matter that much as long as I can get something out of them as far as where we think we can stabilize this property. Whether it's pushing rents, reducing operating expenses, there's probably a combination of those 2 or 3 things.
Again, also having a good broker is important on that too.
Yes.
Not like they're giving you realistic numbers and not
Yes, exactly.
too far-fetched.
And then I'm going to take this data and I'm going to come up with my own assumptions based on my market knowledge, looking at a lot of deals based on comparable properties, looking at the rents in the market. And then I'm going to talk to property management and get an understanding of where we think we can stabilize this asset on an operating expense basis. I'm going to have, various tax consultants and insurance consultants help me out with those line items. It's Those are two big ticket items that, I'm not a professional in insurance or taxes. I have a general idea of where they're gonna land, but I'm gonna hopefully lean on those consultants to help me out there. But for this purposes, we're gonna keep it high level. And I'm gonna stick to this net operating income line right here. So I mean, in place NOI is 1.9 million. The broker's saying you could probably stabilize around 2.38 million or 11.9 thousand bucks per unit per year. And based on my, high level underwriting, adjusting some metrics on vacancy loss, where the market's at, where I think it's going to be, adjusting some rents, probably going to come in a little bit below brokers rents, depending on my opinion of the comps and all that. I'm going to get to a stabilized NOI roughly of 2.25 million bucks, which is around 17% higher than in place. So there's true value creation there, assuming your numbers are generally in the ballpark, right? And also I'm going to adjust my operating expense ratio because for 2007 vintage, let's call it a great little pocket of Kansas City, you should probably be able to operate that thing less than 50% operating expense ratio, all things considered. So still staying kind of high level here. Cap rate, people talk about cap rates all the time. There's many ways to look at a cap rate. There's an in-place cap rate on T12 numbers, which in this case, a pricing guidance of 38 million is going to be around 5.06 cap rate. There's the broker's stabilized NOI cap rate. That would be around 6.26 here. And then there's kind of your high level underwritten cap rate, which would be around 5.93. So you're going to be in the ballpark on this deal. Around a 5.93 cap for this vintage is pretty interesting, depending on how much CapEx, depending on how much additional fees and closing costs are really baked into the deal at the end of the day. But this deal has enough juice on it, I think, to pursue further. And really the reason why is getting down here into the weeds a little bit more, but I'm going to pretty much compare my exit cap assumptions, which again, nobody knows what an exit cap is going to be like in 5 to 7 years, 2 years or anything, but I want to have a scale, right? So if I'm exiting at a 6.2 cap, I'm already out of money. I'm already going to lose money on the deal. Not interested. If we're going to scale down a little bit, it gets a little bit more interesting at a 5.26. So really, I'm going to be in the money at a 5.26 exit cap because of my assumptions here, and I'm buying at a 5.93 cap and a yield on cost of 5.4 on the total project level. So
that's what's called a stress test. He's stress testing the deal right now based on his cap rates.
Yeah, it's really just a quick snapshot of stress testing entry yield on cost to exit cap rate to see if I could rationalize an exit price, rationalize an exit cap to see if the deal is really worth pursuing further at pricing guidance.
Well, let's say if this is Houston market, what's the expansion cap rate you're looking at right now?
I'm not underwriting cap rate expansion right now. It's controversial, right? Everyone wants to underwrite cap rate expansion. I'm going to talk about this later, but I think we're in a buyer's market. We're definitely not in a seller's market. Nobody wants to sell. If you're an owner, it's a bad time to sell. I think we're in a buyer's market, and who knows where we're at, if it's, phase 3 or phase 4 of the cycle where it's really a buyer's market, but it feels like a buyer's market to me. And there's going to be more transactions coming, I think. It's tough to tell, but in general, I'm trying to underwrite at least, I'm trying to see if the deal works first at neutral cap rate. If I buy at a 5, if I'm buying at a 5.93, am I in the money at a 5.93? No, in this case, I'm not. I need some cap rate compression for the deal to pencil. That's not including assumable debt or any creative financing strategies here, but question.
Got a question. Look at this stabilized NOI.
Yeah.
I just want to make sure I understand. So I'm looking at the green.
Yep.
And that's your cash on cash return, as I understand it. And then I go down a couple lines to rate and I see 5.75. That's your debt rate. And so if you're borrowing at 5.75 and investing at a lower rate, how are you generating return?
Yeah. So one thing I'm going to first talk about here is, what is the yield on cost? Actually, I'll back up. What is a cap rate?
Sure.
So cap rate is essentially just if I bought the deal all cash, I don't use any debt. That's essentially my yield on my equity, right? So if I'm buying this deal all cash, I say I have $38 million and I want to buy this deal, then I'm getting 5.93% on my money on a stabilized NOI, right? Now we got to factor in other stuff. This is where it gets kind of tricky, right? Interior CapEx, exterior CapEx, loan fees, legal fees, title fees, acquisition fees, working capital, taxes, insurance, due diligence, contingencies, all that. Somebody's gonna pay for it, whether it's the lender, whether it's you. That's adding to your basis in the deal. And the yield on cost is just your cap rate on your cost. It's not your purchase price, it's your total cost, which factors in these additional deal costs into the deal. So that's why your yield on cost is gonna be lower, in this case, 50 bips lower than your cap rate.
Basically, the yield on cost is the first year's yield. And you, basically you're saying you get these one-time costs in year 2, 3, 4, whatever you likely won't have. You might think about that, right?
A yield on cost is really just a cap rate, but factoring in these additional costs. And if you can get to a point where your yield on cost is higher than your cost of borrowing debt, then you're looking really good. Generally, though, right now deals are tough to get to that point. I would say if you can get your cap rate above your cost of borrowing, you're going to be generally winning. You know, as long as your basis makes sense and your debt's structured right and your capital structured right.
You're not seeing a whole lot of this.
No, you're not seeing a whole lot of that. It's tricky to make that work.
You know, why, I'm surprised that your exit cap rates you're looking at carry going in cap rates as opposed to some sort of, you know, taking a little bit of a more, I would call it conservative estimate that in the future,
Yeah,
your exit cap might be, elevated
yeah.
or elevate.
Yeah.
Is that not traditional?
It is the standard, you know, by the book rule approach to have some cap rate expansion. However, in my opinion, this is a buyer's market. And if you're not trying to get deals done right now, you're not going to get deals done when it flips to a seller's market. So
take extra risk today because of that?
not take extra risk, but make sure you can get to a point where you're not a forced seller.
Okay.
Limit your downside. And if you can limit your downside by justifying basis, getting the positive leverage on your debt, then you're not going to be a forced seller in the future. And, you know, who knows when it's a great time to sell, right? There's going to be cap rate compression eventually, you know, 5, 7, 10 years, who knows?
I think so. That's why we do this analysis.
Yeah.
So that your eyes open on this stuff.
Yeah, you're trying to really identify opportunity and take risk adjusted acquisitions. And now, in my opinion, is a great time to do it. The past, you know, 2021, 2022, peak pricing, everybody's buying 4 caps, 3.5 caps. I didn't get it, right? And you're writing cap rate compression or parity cap rate, whatever you want to call it. On top of that, that didn't make any sense to me. Now we're in kind of a different market where sellers are trying to, you know, figure out prices, buyers are trying to figure out prices. There's a lot of uncertainty. It's not an amazing time to buy, but it's a good time to buy. And I think it's time to get, you know, somewhat aggressive on your exit assumption, on your exit cap rate, because, you know, we're 100 bips higher, 150 bips higher in some asset classes on cap rates right now.
How are you factoring in momentum of the market? For example, I just think there's certain markets that are going to see decreasing rents and really struggles for the next 5, 10 years. Then there's markets like the one we're now where I feel like there's substantial momentum, job incomes. We're more mobile as a society. I'm just curious of how much, you don't want to get too much bias into your numbers where you've fought into some story, but at the same time, I think all the real estate out there, multifamily is going to really shift because of communities and areas that are momentum. Coastal cities may be having more difficult times.
Yep.
But how much do you buy into that momentum? Because that's where maybe some yield.
Yeah, I mean, that's where this stuff kind of comes down to more of an art than a science. You want to boil all this data down to a science, but at the end of the day, you're betting on the future. And if there's areas like, you know, I'm from Dallas, you know, there's booming population growth in Salina and Frisco, McKinney and Plano, everything north of the tollway. You know, it's kind of hard to say like, that's not a great market to invest in. Like you can see the population growth, you can see the construction activity, you know, houses are getting scooped up still. As far as baking that into your assumptions, you know, I'm trying to look at various things. I'm trying to look at what's my going in basis relative to replacement cost right now. That's a big one. Like what's my downside risk if some developer had to come in and build this thing right now? What are they building it for on a per unit, per net rentable square foot number? I'm also going to look at, you know, historically over the past 10 years, you know, what has been wage growth in this area, median household income levels. You know, in Dallas, there's a nice mix of finance jobs, banking jobs, healthcare jobs, and having a good mix of that is really important. I think as far as, you know, forecasting future rent growth and economic vacancy and stuff, you know, it's really tough. I'm not going to lie, it's very tough. But coming up with realistic assumptions based on data sets on where you're seeing future supply, levels, where you're seeing population growth levels, weighing supply and demand, every deal is going to be different. But coming up with a story on where you think it's going to be and having realistic data and limiting your downside is, that's the name of the game. I don't have a good answer for it though.
And that's kind of what Missy was talking about too, like on the like, yes, we're not looking at the deal in Houston the same way as I'm looking at the deal in Rogers, Arkansas. I'm not looking at, Dallas. I'm probably more aggressive on the deal in Dallas or Northwest Arkansas than I am in Memphis, Tennessee. I'll tell you that much.
So you just-
It does go into a little bit more weight, but what that weight looks like is at a cap, like, that's more Nick looking at the high level. We're like 39 people a day in Northwest Arkansas. That's awesome. And then Dallas Metro is 418 a day. Is moving into the Dallas Metro. It's like, that's a weight, but also what's that? What's the volume and supply look like? What's that look like? There's some markets a lot more intricate there too. We're not underwriting. You can't underwrite a deal in East Springdale the same you can as a deal in East Rogers. So there are, but that goes in. But you're looking at that numbers when you look at the market tells that the story, because when he's calling his property managers on assets in Springdale and Rogers, he's seeing how fast they're leasing up. He's seeing what the rents are achieving. So then you're actually getting a good picture of the market, and the market's getting told by what your rent assumptions are and what your rent growth are. What's the historical rent growth? What's the population growth? What's the supply? So absolutely, there is some variance in markets and how you're exiting that, and also the asset type is important too. There, that's what this cap is.
You also just focus on like the South region versus like the West and the Northeast and Midwest, just to specialize in that region.
So you're talking about specifically in the United States where,
Yeah.
it's tough, like the coastal areas, like Paul was talking about, those are getting pummeled with higher insurance costs, upwards of $1,000 a unit, $2,000 a unit, stuff you just can't underwrite, black swan events. Like we're trying to avoid uncertainty here. We're trying to strip away uncertainty, have as much certainty and limit as much risk in these numbers as possible. It's tough to underwrite 100% insurance increase. You just can't do that. So personally, I'm not super excited about coastal areas. I'm more focused on central states where there's lower insurance per unit insurance numbers, where there's lower tax millage rates. Northwest Arkansas, really great millage rates compared to Texas, actually has very high property taxes, which can crush property owners. That's a whole other story, but it's weighing the pros and cons of certain markets and kind of just gathering all this information and being more selective on the regions like you're talking about, being more proactive, I guess is the word I'm looking for.
There's also, if I can just speak up for a second,
Yeah.
an element that's not in here, so not necessarily an omission on your part,
Yeah.
but if an investor and after tax rate, you can basically write off more cost of debt, so you can bring some of that down to the expenses.
Mhm.
How does that work? How does that pass through the investor at the LP level?
The same way we do our investor split. So if there's an 80-20 split to the investor after the preferred return, they're getting 80% of the tax benefits and 20%. Same thing on profit. So how we structure the deal to the investor on the equity side is how we do it on the tax appreciation. And none of these numbers reflect the tax benefits that you're getting throughout the life of it. So that's just like the icing on the cake. But some people, they have tax problems, and like that's like one of the main reasons why they invest in real estate. But we're not looking at the numbers wise.
And it's usually listed in the operating agreement.
Yeah, I guess some people will try to include that on the, we don't include that on our numbers, but some people might try to factor that in.
But depending if you're
That's our
goal for a partnership, it should make a difference.
Yeah, but that is one of our top, like, we're very good at getting good, like, so everyone can get a cost segregation, but pushing back on, looking at the land value, pushing back on the different items out there and backing in with the cost seg, we'll do that and get more depreciation on than it would.
So I'm not going to get too in the weeds here, but in that last example, they wanted $38 million. We're still kind of off on price, I think, on a high level. So I'm going to go ahead and ask the broker three quick questions, or the owner three quick questions, kind of gauge really how motivated they are to get a deal done. Are they flexible on price? Would hard money, meaning hard money day one, earnest money day one, help their motivation at all to come down on price to show that we're very interested and we're serious buyers? The second thing I'm going to ask is there any assumable debt on the property that could help me kind of financially engineer the deal to make it work? And what are the terms of that debt? And the third thing is, are they open to any sort of self-financing? Kind of ties into assumable debt, just trying to financially engineer the deal to make it work. That's a big thing that we're looking at right now is assumable debt with at least 5 to 7, sometimes 10 years of term left on it, plenty of IO and a low rate. It's hard to make a deal pencil right now, but if you can get really attractive debt and tie those things up for a number of years, then that's, in my opinion, a great opportunity. Keep going here. And so detailed analysis, we don't need to get too in the weeds here because it's sometimes kind of boring to talk about this stuff when you're not actually on a spreadsheet, but there's T12 analysis, unit mix analysis, future rent growth, which we kind of spoke about a little bit. Rent comp or stabilized and future rent sale comp analysis. This is just scratching the surface on what we're going to do when we're underwriting a deal. There's extensive hours that are invested in all this upfront analysis to put a deal together. So that's why you have that high level underwriting funnel. So you can kill off stuff that doesn't make sense from the start because there's a lot of hours invested to get a deal done. So T12 analysis, this is just looking at the trailing 12 months of a property to identify historical operating trends and also identify some errors that might be in the financials as well. So, I mean, this is just the property that we're looking at. It's 386 units. As you can see here, their net rental income has it's been increasing, which is great to see. And that's a factor of them increasing their gross potential rental revenue. So they're pushing rents. They're decreasing physical vacancy. So they're occupying more units. Love to see that. Bad debt, that's kind of a problem area that jumps out here. Their bad debt's averaging around 7-8% here, which is pretty high. That tells me this is probably a Class C property with some, questionable demographics, higher turnover. Concessions, nothing too crazy here, around 1-3% some months. Other loss sometimes there's a model unit included or something like that. But overall, love to see net rental income increasing each month and effective gross income or revenue also increasing. That's just adding in other income. Also looking at operating expenses, how they're trending each month. Sometimes there's some variances on a monthly basis, but that usually doesn't matter too much because you're accruing these property taxes over a trailing month, 12-month statement.
On the bad debt,
Yeah.
Are you able to just kick people out, or do you have to go through a foreclosure or like
Eviction?
Yeah, eviction process.
Yeah, it depends on the market. It depends on where you're actually investing. Some states and counties and cities will have easier eviction laws where you can just get them out. I'm not super familiar with the process, but generally blue states are going to have more resident friendly laws, meaning it's harder to evict them versus red states. So it just depends on the market. And overall, I mean, the other thing that would jump out to me is they didn't accrue for total insurance on their T12 financial statement. So, obviously you got to include property insurance. It's just a way to catch this stuff.
How often do you see someone who negates to put something in their T12 when they hand it over?
Not incredibly often, but you definitely catch it.
I mean, insurance is a pretty big factor.
Right. Yeah.
I mean, regardless of where you're at, even if you're in the middle of the country, we have hell here. We have.
Yeah. I mean, in that instance, I would just simply, get an insurance quote for what I think insurance is going to be when I acquire it. And I would apply that to their trailing 12 financials. And I'll say, all right, this is what it should have been. Yeah, it tells me they're a bad operator because their financials aren't accurate, which actually is a good opportunity to buy it and improve operations. So it kind of tells a story that way.
Love how you spin.
All right, unit mix analysis, the second thing in the more detailed approach. So this is really just looking at a property with 276 units and 256 are occupied. It's really just a snapshot of where the property's at today on a unit mix basis. And really, this is helpful for me to identify tagged renovated units. Sometimes they're going to call renovated units with an R in their unit type in the rent roll. So you can kind of see, all right, this, renovated 842 average square foot unit versus the classic 842 average square foot unit. They're both 100% occupied. That's great. But the average in-place rent is very different than the two. So that tells me there's a nice renovation premium that we can get here, roughly $150 or so, depending on what CapEx is invested to get that premium. I'm also going to look at max in-place rents, which is, this is sometimes a misleading representation because they're signing rents with heavy concessions or short lease terms. But this also gives me an idea of maybe we can push rents to these levels if X, Y, and Z happens. So I'm going to dig into these leases and understand what made these leases sign at these elevated rent levels. Because I mean, you're looking at this number here, 1849 max in place rent versus average in place rent of 1613, over $200 difference. Like that could make or break your deal. And then I'm going to have a underwritten rent, year one underwritten rent column. This is, it's an art, not a science, but your underwritten rent, I generally like to have at least some units hitting my year one underwritten rent. It's a conservative underwriting approach that I take. A lot of operators are gonna push all unit, all rents the first year. I think that's pretty aggressive. I think your best comp is the asset itself. And understanding, all right, this is my asset. These are my rents that I'm getting on 13 units in this instance. I need to replicate that for the rest of these units. And then I'm also gonna weigh, the comparable properties and see what they're doing better or worse and the market in general. But this is just, a unit mix analysis snapshot that I do for every deal. Any questions on this?
Future rent growth by unit type.
So yeah, I mean, future rent growth, very, very hard to nail down exactly where stuff's gonna land, but at least you can see where each unit grows on a yearly basis to kind of visualize, all right, if I'm renting this unit, my rent's, gonna be 2023 for the first year, then that's 100% increase, then it's another 100% increase on the 4%. Like these rent bumps on a percent basis versus a chunk rent basis vary based on where your starting rent is. So if you're starting rent in a more affordable market like Northwest Arkansas compared to a Dallas or DFW, which has already experienced substantial chunk rent growth. I mean, we're in the probably call it like $220, $235 a square foot for certain types of new construction, wrap style podiums, probably getting to like $265. That's already pretty expensive based on the demographics and median household income levels. So I'm not going to get as aggressive on future rent growth percentages unless there's a story that really makes sense and there's strong conviction that that's going to pan out. A market like Northwest Arkansas, it's a growth market. There's a lot of opportunity here as far as land and new development, a lot of jobs with Tyson, JB Hunt, Walmart, et cetera. I'm probably going to get more aggressive on future rent growth, but the deal still needs to work without those more aggressive assumptions. So it's something that you kind of tweak throughout your underwriting. And I'd say the one other data point that I'm going to carry along the growth of the rents is the median household income within a 1 to 3 mile radius to kind of weigh the gross rent as a percentage to that income level. You generally want to stay well below 30%. Depends on the product type, location again, but that's kind of a gut check to see if your rents are out of whack relative to the market.
So in the longer run, your rent's going to grow as fast as the median income, right?
Yeah, generally.
So basically adjust out, and once you meet that, it's a small run.
Yeah, I mean, generally your income levels are also going to grow. I mean, but for this analysis, I like to see over the deal life cycle, if I can get a deal to make sense and I'm staying under 30% gross rent to where income levels are today, that makes me feel really good about the deal from like an affordability standpoint. All right, rent comps, won't get too in the weeds here, but there's a million ways to do rent comps. I think the best way is just calling up property management companies, getting their take on where rents are. Units are leasing in that property, and getting their take on what's leasing well, what's not leasing well, where concessions are. And I'm gonna map it out on a Google Maps to understand what's my radius of comparable properties look like, where are the better rents, what's kind of in right now. Is it garages are a big thing, attached garages, detached garages, people like that a lot. Private yards are good, green space, people like that. So it's looking at the comparable properties and just using that data to come up with your own underwritten rents throughout the deal cycle.
Have you looked at note buying yet?
No.
Of the underlying multifamily assets?
No buying?
Note buying.
Oh, note buying.
So you buy the underlying debt of the multifamily piece. So I think you're gonna see a wave of reverse engineering a deal based on the liquidity of the banks because they're sitting on 3 to 4% mortgages. They basically have dead money in the bank. They've got it if they want them paid off. So they'll sell at a discount that'll give you a premium return on the underlying asset. And then if it's overpriced on its underwriting, you either take it back and control the asset, or you'll actually get paid off and get your yield above what your cost of.
I love it. Yeah.
So it's.
I think that's one of the ones that we're hearing on the reports and stuff. It's like a huge opportunity coming with all this debt maturing, buying the notes of the distressed assets.
Yeah, and you buy them at such a discount that you fight the trend. Instead of the 350 deals you turned away, you look at the ones that are structured. You go to CoStar, get all that information. Right? So, but I would. It's good. We're aggressive. There's 41 banks here. We're aggressively making sure we're in contact with them to make sure that.
I'm going to use you to fund those deals.
I love it.
Yeah.
It's only because it's just pushing the opposite trend, especially if they've overinflated, they've done 10% annual increase in rents.
Yeah.
That debt's gonna retrade, so the bank already knows it, and they can't take the
Yeah.
loss right now because the examiner comes in once a year, he'll reassess the asset.
Yeah.
He'll mark them down sometimes 5 to 10%. They'll have to take a hit on that loan. So he'll sell it to you at a discount so that you can.
Yep.
Anyway, it's coming in a big way, on good assets.
Yep. I definitely agree with that. If you can find those opportunities, that sounds like, a home run situation. Yeah, I mean, in a lot of cases, the property value today is not worth the debt. So, yeah, in that instance, I've never done a transaction like that, but I'm gonna lean on you to help me out and find one. And I'm excited for what's to come. I mean, that's definitely very interesting though, note buying.
Yeah, we've looked at, deals direct from like lenders too, some of these distressed deals, and like Nick said, like, sometimes it doesn't even make sense for what they owe on the property. And, that's usually, that, he said there are risky A-class deals, risky, low risk C-class deals. Most of those deals that we're seeing are C-class deals. We have seen some developers that maybe got too high and, they're looking at. But that's not as distressed as some of those C-class direct lenders.
Have you found motivated banks to offload their notes yet?
They're getting motivated when the examiners come in there to get really motivated. The bigger problem is they're not always distressed assets, but if they've got a 3% mortgage or a 4%, they need to be, they're losing money on that loan sitting in their bank. They've got to get it off their books. And that's why they're not lending now, is not because they don't lend, is they have no capital. Their deposits have depreciated. So they're just sitting there with less deposits and a dead asset. They want it off their books. So they'll take a discount to get rid of a 3% mortgage off their books.
Is there anything from perspective?
Yeah, we did great.
There you go.
No, it's y'all are great.
Would they just actualizing their loss, and that would post the same way to the balance sheet as holding that debt?
Yeah, there's certain banks that are in liquidity crunch right now. They need stuff off their books. No matter what the cost.
Sure. Armis would rather borrow money from the feds to help in liquidity. Or as a few dollars left,
Yeah. It's cute.
All right, so what are the later things later things we'll look at during the deal? The sale comps, this is really getting an understanding of basis and downside protection, where stuff is traded historically. I mean, it's tough to get really good comps just because the market was inflated in 2021 and 2022, but the more information you have here, the better. I'm gonna look at stuff, across metroplexes. I'm gonna look at stuff that has comparable build. If it's a build to rent product, I'm gonna look at build to rent sale comps. If it's multifamily 3-story garden, I'm gonna look at comparable sales to that. Mixing the two product types doesn't make any sense in my opinion. The other thing I'm gonna look at is, price to unit, price per net rentable square foot. If you can get the pro forma cap rate, that's great. If not, no worries. And then I'm gonna do a little bit extra here, and I'm gonna look at, what's their asking rent today. And I'm gonna look at on a rent per unit and a sale price per unit, what does that percentage look like? Some of these deals trade up very low rent per unit, sale price per unit percentages. Tells me they probably overpaid a bit. And, I'm gonna compare that. I'm gonna compare all this data on sale comps to where we are buying, or where we want to buy a deal, which would be down here. So for this deal example, we'd be buying at 187 a door, 153 net rentable square foot, which is roughly a 582 pro forma cap rate. Asking rents at the property right now are 1973, very good. Rent per unit, sale price per unit percentage over 12%, which is higher than pretty much everything in the comp set. And also a price per net rentable, same ratio there.
I think important here too, like, we're not just looking at the price per door. There's other costs than just the price per door when you're buying a property. You have title costs, you have lender costs, you have attorney costs. So you want to look at what your total capitalization is, because that's going to affect your end price. It's not, we're getting in at 180 at 7 a door. What are you really getting in after all the cost of capital there too? So that's super important. This cost of capital will help if you have a good basis, but really this isn't your all-in number. This is your all-in number. Also, what you talked about extra, you could just look at these recent sale comps, pull from CoStar or wherever, but here you can see this is weighted at 1964 comp doesn't have the same weight as 2021 comp to your 1999 project. You're factoring that. That's not to say you're not factoring these other in, but they probably have, you're going to weight those a little bit different based on their age to there. So I think that's super important. You're not throwing them out of picture, but you're giving them. You're looking at the whole picture. So.
Yeah. I mean, sale comps, I think if you can get as recent as possible with a sale comp and like kind of product, that's really the goal. Because that tells you where something very similar and very recent is traded. But obviously it's not, that sometimes that information in non-disclosure states isn't readily available. So talking to brokers, getting information from other groups is really the way to go there. We're gonna talk about a quick case study. We're still in time.
Maybe 5-10 minutes.
Yeah.
Getting close.
Okay, cool. All right, so this is for a deal that we closed back in September, Stony Creek, up in Rapid City, South Dakota, 278 units. So the source of this deal was a local broker, semi-off market, small buyer pool, not a lot of competition. Love that. We're not going to be doing multiple biddings, running up a price. Year built 2008, pretty good vintage. It's 278 units, average unit square foot 937. Current occupancy 99%, and it's averaged 99% over the past 4 years. That's important because it tells me, the owner really hasn't pushed rents to where they should be. They've just been maintaining occupancy, which is, some operators do that. Other operators are going to optimize the NOI, push rents more in exchange for less occupancy. I think around 94-95% is kind of where you want to be, assuming you get those good rents. All right, so we liked this deal for several reasons. And every deal that we end up doing is going to have a similar write-up, thesis, and business plan like this. So we already purchased another asset from this owner, which is performing well. So that's good. There's historical purchases with this owner. They've operated the last asset well. They're operating this one well. The basis feels pretty good with limited downside for this vintage. Highly sought after location in South Rapid City submarket, good income levels and low crime. A great property layout with over 27 acres for 278 units, very low density for this product. Great feel for the property when you actually visit it. It's open, there's a lot of green space. You're up on this mountain in Rapid City overlooking the rest. So it has a really good real estate value from a land basis standpoint. Large 937 average unit square foot floor plans. When talking with property managers in the area, other operators, larger floor plans are kind of the trend for the submarket, kind of servicing to that more family demographic, more retirees that generally just wanted more space. So we like that about it. Strong trending income with T1 income cap rate of around 6.3 versus T12 income cap rate of 5.6. What does that actually mean? Trailing 12-month income just looks at the last 12 months of total income and compares that to my last month of income annualized. So this is really just telling me that they've grown income significantly over the last 12 months. They have started to push rents, but haven't turned all the units to where they could push rents in the future, which tells me, man, this is a really good opportunity because they're already proving out our business plan to push rents further. Other reason is an off-market deal, semi-off-market deal, no call for offers with a bidding war. Not to say all off-market deals are good deals by any means. Every deal has its own story. Seller was the original developer. He's owned it for over a decade, and this was the last asset that they owned in the submarket. There's motivation to sell. They want out. They're just exiting, and they want their price and they want certainty of close. So those are the two things that they highlighted.
I've got a couple questions. One, when you're doing your due diligence, are you looking at the tenure of the folks who have been in those units and taking that into consideration about how long they might stay?
Yeah, definitely.
And then the other thing is, so when you have an off-market deal, what's the reason? If I was a seller, I probably wouldn't go for an off-market deal where you just have one buyer. I mean, why not have your broker open that up to basically everybody? And how do you, why would a seller do that?
Yeah, for the first question, yes, we definitely look at tenure of residents, comparing when they signed a lease, when they and how long they've actually been there. That kind of tells me, all right, they like living there. They've been there for a while. What was their rent when they started versus where it is now? Love to see resident retention. That's always a good thing. And then to your second point, why would a seller go off market? I can't speak for sellers. I've never sold real estate myself, but Paul, you maybe want to take that one?
I think it happens. They have concern of brokers in general, honestly. Yeah. So it's just this weird thing. They think sellers are not represented.
Some people like to just run that way.
Yeah, I mean, putting it on market can be stressful too, like you have to run the traps, you have people poking around your property, you have people poking around your team, you have.
You don't want your people that are renting to know you're selling it. There's just a lot of.
They may have pricing expected, like this is what I can say, if you can give me this price, sometimes you can achieve that price in the off market deal, maybe that's not, maybe they could get a little bit more taking it on market, but if they know they can get a deal done fast off market and less work for them, sometimes they'll do that.
You know, you can close.
Yeah.
You've already done that before, right?
Yeah.
Other assets.
I get calls from people, they don't want me to tell them anything about what's on market, only off market. That's all they want to know.
Like on the buyer side, why you're on market.
Yeah.
It's much simpler.
But there's buyers that only operate that way. Yeah, they want to run in that alley.
Maybe if I'm that rich and I see the opportunity with Gen AI in the stock market, I'll sell that at a low price. Buy NVIDIA.
I mean, you don't want to drag it out for 2 or 3 years, right?
Yeah.
All right, briefly talk about this, on this deal, there's just, okay.
Yeah, yeah.
30 seconds.
Probably wrap up, quickly go through.
All right, well, I mean, these are just high level metrics that, you know, we like the deal because we stress tested a million ways. And there's great upside, limited downside, even when exit caps on this deal were above 6.5 market cap rate for this asset. I mean, probably call it around 5.5, 5.75, which is where we pinned it. Great risk adjusted returns, great asset. And we really don't have that aggressive NOI growth to achieve the business plan. I think there's kind of two ways to quickly determine if a deal makes sense as a passive investor. You look at NOI growth from now into exit. What is that over the life cycle of the deal, and your exit cap rate? You know, those two things can make or break your deal. So if you're growing NOI 12% a year over a 5-year deal, that's just, in my opinion, probably way too aggressive, unless you're just some amazing operator with some crazy skills or something like that. But definitely don't want to have those two metrics, very high NOI growth and aggressive cap rate. So this deal, though, checked all of our boxes, and we ended closing up. Yeah, we closed on it September 23, $20 million equity check, total capitalization of 50 or so $million. I don't know how much time we have left, but this just goes more into the deal.
Awesome, yeah, appreciate it.
Well, thank you, Nick, for driving, you know, I think he missed his flight and wanted, he's like, I'm gonna make it here, but I'm gonna start this bloody drove all the way here, so appreciate you making it back all over this with us. And thank you, Brian, for chiming in for your presentation as well. Again, this is live streamed to our Northwest Arkansas Commercial Real Estate Facebook group. If you're not in there, make sure you join. There's a QR code up front that leads you there. And our next presentation is gonna be for next month, is gonna be our Skyline report. So I focus specifically for commercial real estate.
Another really smart guy.
Yeah, very.
You guys probably know Mervin from the University of Arkansas Economic Research. So he's gonna be talking about the commercial real estate market. So if you have specific questions, I know because, you know, I've been to quite a few of those sessions. There's like so many questions on all types of spaces, so we can ask more drill questions with him as well.
This may be at the new Rogers location, so stay tuned. For now, we'll be here, but this could be at the new Keller Williams Rogers location.
Okay, then I'll say thank you, Keller Williams, for letting us use the location. We'll be consistent using it. We'll love the Zoom integration. Makes it easier for everyone from a recording and also the folks.
Location's good, yeah.
Yeah, and we're excited about the Rogers location, because it's something more central for everyone as well. Is there anything else? Oh yeah, if anyone's interested in sponsoring, or know anyone that wants to sponsor, talk to Brian and I, or keeping up the sponsorship for the remainder of the year. I will have some other events planned out throughout the year as well.
Yeah, I hope you guys got some value, and I think the networking was really good too. Hopefully we can all do some deals together, and really looking forward to seeing you guys all out for another special event next month.